Divorce is one of the most financially complex events a person can face. The decisions made during this process can shape the next chapter of a life for decades. Welcome to Advisor in Your Corner, the podcast for individuals navigating the financial realities of divorce in California, and for the attorneys, mediators, therapists, and coaches who support them. Your host is Alex Weinberger, a certified financial planner professional and certified divorce financial analyst. Through his firm, Marriage Financial Solutions, Alex consults directly with clients on the financial side of divorce, and the firm welcomes engagements from listeners and from the professionals who serve them, bringing clarity to the questions that matter the most to you without the jargon. This is Advisor in Your Corner.
There's a moment in a lot of divorces when everything narrows down to the house. Not the retirement accounts, not the brokerage statements. The house. It's where the kids learn to walk. It's the kitchen, the backyard, the street you know in the dark. So when a marriage ends, keeping it can feel less like a financial decision and more like keeping your footing. I understand that completely. And I want to be useful to you today in a specific way, which is to make sure that when you decide what happens to your home, you're seeing the whole picture and not only the part you can feel. The house is the one asset that's heavy with memory. It's also, quietly, one of the largest and least flexible financial decisions you'll make in the entire divorce. Both of those things are true at the same time. Let's hold them together for the next 20 minutes. So here's where we're going. I want to talk about why your home isn't the same thing as cash, even when it looks that way on the balance sheet. I want to walk through a tax rule that quietly changes the day your divorce is final, the one that surprises almost everyone. I want to talk about the hidden number that comes attached to the house, the one that never shows up in the appraisal. We'll talk about what it really costs to carry a home like this on your own, and then I'll give you a clear way to make the decision, one that lets the house be more than a number without letting it stop being a number. Let's start with the most important idea, and it's a simple one. Your house is not cash. On the spreadsheet, your attorneys are passing back and forth. The home shows up as a number. Say there's $2 million of equity in it. Right next to it, there might be an investment account, also $2 million. On paper, those two look interchangeable. Take the house, take the account. Either way, you walked away with $2 million. They are not interchangeable, and treating them as if they are is one of the most common and most expensive mistakes I see. The account is liquid. You can spend it, invest it, draw an income from it, move it, divide it. The house is a single, concentrated asset you can't spend a hallway of. To get money out of it, you either sell it or you borrow against it, and both of those come with costs and conditions. Same number on the page. Very different financial life. There's a second layer to this, and it's the one I most want you to hear, because it's the part that's almost invisible until it isn't. The $2 million number on the house probably isn't really $2 million. There's a tax sitting inside it. Here's how that works. The federal tax code gives homeowners a generous break when they sell their main home. If you qualify, you can exclude a big chunk of the gain from tax. The gain, roughly speaking, is what the home sells for minus what's called your basis, which is essentially what was paid for it plus the cost of improvements over the years. For a married couple filing jointly, the exclusion is up to $500,000 of gain. For a single person, it's up to $250,000. You see the problem already. The day your divorce is final, you go from being able to shelter $500,000 of gain to sheltering $250,000. The exclusion is cut in half at the exact moment you might be deciding to keep the house and sell it down the road. Now think about what that means here on the west side of Los Angeles, where a family may have bought a home 20 or 25 years ago for a number that sounds quaint today. The gain on a long-held home in this part of the world isn't $250,000. It can be well over $1 million. So the difference between sheltering $500,000 of that gain and sheltering only $250,000 is real money. and it lands entirely on you if you're the one who keeps the house and sells later as a single person. Let me put illustrative numbers on it, and please hear these as illustration only. Your real numbers will be your own, and your tax advisor will run them properly. Imagine a home bought long ago, and the gain at sale works out to $900,000. As a married couple selling together, the first $500,000 is excluded, leaving $400,000 potentially exposed to capital gains tax. As a single person selling the same home, only $250,000 is excluded, leaving $650,000 exposed. That's an extra $250,000 of gain in the tax conversation, purely because of filing status. The house didn't change. Your marital status did. I'm not going to give you a tax figure on that because the rate depends on your income and other factors, and that's a conversation for your CPA. But you can see that the number is not small, and it's the kind of thing that's easy to miss when you're focused, understandably, on simply keeping your home. There are also rules that exist specifically for divorcing spouses, and this is where I want you to lean on your attorney and your tax advisor together, because the drafting matters. To get the exclusion at all, you generally have to have owned and lived in the home as your main residence for at least 2 of the 5 years before the sale. When a marriage is ending and one spouse moves out, that clock can become a problem. The tax code has provisions that can help. For example, a spouse who moves out can sometimes still be treated as using the home. For purposes of that test, during the time the other spouse lives there, but only if the divorce or separation agreement is written to provide for it. That's not automatic. It's a function of language in a document. So if there's any chance you'll sell the home in the future, the time to protect that tax treatment is while the agreement is being drafted, not after. Your attorney and your tax advisor are the right people to get that language right. My job is to make sure you know to ask. The other piece of this is what happens when one spouse buys the other out of the house. When a home is transferred between spouses as part of a divorce, that transfer generally isn't a taxable event in the moment. That sounds like good news, and it is. But here's the catch. The spouse who keeps the house also keeps the original basis, the low purchase price from years ago. So the embedded gain doesn't disappear. It comes with the house, and it sits there waiting for the day you sell. This is why I keep saying the house worth $2 million isn't really $2 million. If a big gain is built into it, the after-tax value of keeping that house is less than the sticker, sometimes meaningfully less. And if you trade away a liquid investment account to keep the home, you may be trading a clean dollar for a dollar that has a tax bill stapled to its back. So that's the tax picture. Let me move to the part that shows up every single month, which is cash flow. A house isn't only an asset, it's an ongoing expense, and the expense doesn't care that you're carrying it alone now. There's the mortgage, if there is one. And here's a piece that catches people off guard. If you're buying out your spouse's share of the equity, you're often refinancing the home to pull out the cash for that buyout, which means you're refinancing into today's interest rate environment, not the comfortable rate you may have locked in years ago. You also have to qualify for that new loan on your own income and your own credit, which is a very different conversation than qualifying as a 2-income household. Then come the costs that never stop. Property tax, insurance, which has gotten dramatically more expensive in parts of California, and on an older or larger home, real maintenance, a roof, a system that fails. The kind of 5-figure surprise that used to be a 2-income problem and is now entirely yours. Let me make this concrete with a hypothetical. We'll call her Diane. Diane wants to keep the family home, and on the surface, she can. Her settlement is sizable, but to buy out her husband's half of the equity, she refinances, and her new monthly payment is noticeably higher than the old one because rates have moved since the original loan. Add property tax, insurance, and a maintenance reserve for a house that's 30 years old, and the true monthly cost of keeping the home sits well above what it felt like when 2 incomes and a shared history stood behind it. None of this means Diane shouldn't keep the house. It means Diane should know the real number before she signs. Not after the first big repair bill lands. When you keep the home, you keep all of it, and you keep it alone. And this is where the most important financial question hides, the one almost no one asks in the moment. What's the opportunity cost of keeping it? Go back to Diane. To keep her home, she ties up a large share of her settlement in the buyout and the equity. That money is now locked inside the walls. It isn't liquid. It produces no income. It costs her every month to hold. Meanwhile, those same dollars, if they stayed invested and working, could be part of what funds her actual life, the groceries and the travel in the years ahead, especially if she's closer to retirement than to the start of her career. That's the trade-off hiding underneath the word home. It isn't that the house is bad. It's that $1 in the house and $1 invested do very different jobs, and you only have so many dollars to assign. There's nothing wrong with choosing the house anyway, but you want to choose it knowing what you're setting aside to have it. For a lot of people, seeing that trade-off clearly is the single most valuable thing a financial professional brings to the table, because the house is so loud emotionally that the quiet math gets drowned out underneath it. I want to be careful and fair here, because I don't want you to walk away thinking the answer is always to sell. It isn't. Sometimes keeping the house is exactly right. If your children are in a tough year and the stability matters more than the dollars, that's a real and legitimate reason, and it belongs in the decision. If the housing market or your particular home makes holding it sensible, that's real too. There is no universal right answer here. Selling isn't automatically smart, and keeping isn't automatically sentimental foolishness. Anyone who tells you there's one correct move for everyone is not paying attention to your actual life. The goal isn't to reach a predetermined answer. The goal is to make the choice with both eyes open. One more thing before the questions, because the choice isn't always keep or sell today. Sometimes there's a middle path. Some couples agree to hold the home jointly for a defined period, often so the children can finish school and then sell it later on an agreed timeline. That can be exactly right for the right family. It can also get complicated because you're staying financially entangled with someone you've just divorced, and the agreement has to spell out who pays for what, who handles repairs, and precisely how and when the sale happens. There are real tax and legal wrinkles in arrangements like this, and they belong squarely with your attorney and your tax advisor, not on a podcast. I raise it only so you know the menu has more than 2 items on it. Keep it now. Sell it now. Or structure something in between, with clear terms and a clear end date. The point, again, isn't which one is right. The point is that you get to choose deliberately, with the full set of options in front of you, instead of defaulting into the most emotional one, because it's the only one anyone named out loud. So let me give you the way I'd think it through, the questions I'd want you to be able to answer before you decide. First, what is the after-tax value of this house? Not the appraisal value. Ask what the basis is, estimate the gain, and understand how much of that gain your exclusion will actually cover once you're single. That one question reframes everything. Second, can I carry it comfortably on my own, with margin to spare? Not just barely, comfortably. Write down the real monthly cost, including the things that only happen once every few years, and look at it honestly against your income and your settlement. Third, what am I giving up to keep it? If keeping the home means tying up most of your liquid wealth in something that doesn't generate income, name that trade-off out loud. Decide whether it's worth it to you. It might be. Just decide it on purpose. Fourth, if I do plan to sell someday, is my agreement written to protect the tax treatment? This is the question to bring to your attorney and your tax advisor while the ink is still wet. And fifth, does this decision fit the life I'm actually building, or the life I'm trying to hold on to? That last one isn't a financial question, exactly, but it's often the real one underneath all the others, and it deserves to be said plainly. Here's where I'll leave you. Your home is allowed to be more than a number. The memories are real, the stability is real, and no spreadsheet captures what it means to sleep in your own bedroom while the rest of your life is being rearranged. I would never tell you to ignore that. What I'll tell you is this: know the number before you decide. Know the tax that's hiding inside the value, know what it costs to carry, and know what you're setting aside to keep it. When you can see all of that clearly, and then you choose the house anyway, that's not an emotional decision overriding a financial one. That's a whole decision made by someone who can see the entire board. And once the divorce is behind you and you're deciding how the rest of your assets should work for the life ahead, that's exactly the kind of clarity worth having a fiduciary in your corner to build. The house will still be the house, but you'll be the one holding the full picture, and that changes everything about what comes next.
Thank you for listening to Advisor in Your Corner. If today's conversation raised questions about your own situation or a client's, Alex Weinberger and the team at Marriage Financial Solutions are available to help. They work directly with individuals navigating divorce and alongside the attorneys, mediators, therapists, and coaches who support them. Every engagement is handled with the discretion, rigor, and independence the moment calls for. To learn more or get in touch, visit marriagefinancial.com. If this podcast has been useful to you, please share it with someone who could benefit and subscribe wherever you listen. This has been Advisor in Your Corner. We'll see you next episode.
The information and opinions presented in this podcast, including the views of guests not affiliated with Marriage Financial Solutions, is for general informational and educational purposes only and should not be considered personalized financial, tax, or legal advice. Marriage Financial Solutions does not provide advice regarding securities or the advisability of investing in securities. Marriage Financial Solutions is affiliated with Weinberger Asset Management, an SEC-registered investment advisor, and may refer listeners to Weinberger Asset Management when investment advisory services are appropriate. However, individuals are not obligated to use the services of Weinberger Asset Management